Growing up in a working class background, I've always been fascinated by the concept of wealth and becoming wealthy. I can't really explain when and why, and even how it all transpired, but researching about wealth has become a personal obsession of mine and a hobby. So in this YouTube video, I'll be sharing with you some intriguing data on the world's wealthiest 1% portfolio. This report is on Knight Frank's website, so it's available there, and it's definitely worth the read for anyone who wants to be remodeling their portfolio to the top wealthiest 1%, or just simply being interested in finding out information about the top wealthiest 1%. So before we begin, let's first define what a high and ultra high net worth individuals are. According to the report, a high net worth individual is someone with over $1 million in their assets. And an ultra high net worth are people with over $30 million in assets as well. These individuals are business owners, entrepreneurs, and investors who have basically made a lot of money through divestments or investments of many income streams as well, or income sources. By being savvy with their investments, these groups have achieved a certain level of financial independence and freedom that many of us aspire to reach, but only a few have been able to be successful. For many people, buying a home is an investment for the future because it provides a strong sense of stability. And a home is not just a place to live, but to also raise a family. It can also be a tool to build financial wealth, and it can be passed down from generations to generations. Plus, owning a home offers a tax benefit in some countries where you can claim tax deduction on your mortgage interest. You can also use your home as a collateral to borrow money, which can then help seize investment opportunities and help you with your financial needs as well. Investing in stocks is not just for the wealthy, but for anyone out there who wants to diversify their portfolio and benefit from potential returns. Stocks offer access to exclusive deals, dividends, and capital gains when their share prices increase or goes up. Private equity is an investment option for high and ultra high net worth individuals. It involves buying a stake in a company and taking control of its operations. Private equity firms may use debt or bonds to finance the purchase, and wealthy individuals will partner with these firms to provide funding. Recapitalization is when a firm helps a company raise money by restructuring their finance to reduce taxes. Mergers and acquisitions allow firms to join with other companies to increase market share, reduce risk, and gain access to a pool of talent and resources. By doing this, they benefit from something called economies of scale, where there's a lot more produced with a lot less costs, providing efficiency. There's also diversification of products and service lines, improving customer acquisition and supplier networks to compete with other businesses. The other one is IPO. IPO allows companies to sell shares to outside investors and also make bank. Venture capital firms help entrepreneurs turn their ideas into reality by providing funding in exchange for a stake in their startup or business. They have vested interest in the success of the company and provide guidance and advice. Commercial real estate can make you a lot of money. You can buy buildings and rent them out, or even buy land for a short-term profit or long-term security. There are some tax benefits like deductions for repairs, so depreciation, but there are also risks like extra costs for location, conditions, renovations, and even national or local laws that limit people from doing certain things to it. In the US, 1031 exchange let you swap one income property for another without paying capital gains tax. This means that if you sell a property or land that looks similar to another, but not the same quality or grade, you can just postpone capital gains tax by upgrading to another property without paying a dime to Uncle Sam. So this is a random yet related topic. Did you hear about the collapse of First Republic Bank and some of their assets being acquired by JP Chase Bank?
First Republic Bank has been struggling to stay afloat for weeks, and now a deal to take over the embattled regional bank could come as soon as tonight. A source familiar with the matter tells me that federal regulators are racing this weekend to seize and sell First Republic. One option is for the FDIC to take over the bank and then quickly sell it to another bigger bank.
Listen, I may be speculating here, but this is not the first rodeo for JP Morgan as an organization. They have been shoring up the banking system from collapse since the 1900s. They are old school, the dawn of the dawn. They've been there for a while. On May the 1st, the Federal Deposit Insurance Corporation, FDIC, announced that it had entered into a loss sharing agreement. This means that the losses on First Republic assets will be shared between JP and FDIC. Under this agreement, and this is the crazy thing, under this agreement, JP Morgan will buy First Republic Bank a portfolio of single-family, residential, and commercial loans. It may be loss sharing for now, but in the long run, they will make a hell of a lot of money, including the affluent customers that are in that portfolio and also the prime locations in the portfolio. And a statement by JP Morgan echoes this point, meaning that JP Morgan will see its earnings per share increase and generate over $500 million in added profit every year. On top of this as well, they are projected to gain a one-time payment of around $2.6 billion after tax paid. This lucrative deal sets JP Morgan in a great position to take advantage of even more opportunities in future. This is going to be very simple to explain. A bond is like a loan that you lend to someone and they pay you back with interest over time. When the loan ends, you get all your money back. You can buy and sell bonds and their value depends on the cost of the bond and the interest rate. Bonds are good because they provide a steady return and you don't have to maintain it. You don't have to do a lot of things with it. And it's very, very predictable. It doesn't offer higher returns as equities, but it's a lot more safer and predictable. REITs are like buying a piece of a big real estate. So in a massive scale, you can buy shares in REITs and become a partial owner of the properties that a company owns and manages. So these companies buy a lot of real estate and they buy and they create a fund around it. A company makes money from renting out these properties and the growth in the property's value as well. This is a good way to invest in real estate without spending a lot of money up front. It is so simple and it's very easy. You can buy it through an ETF or something. And according to the law, 90% of the taxable income from the operations must be given back to shareholders like you and I as dividends. I mean, it's a bit like a bond, but a little bit better because the rate that you get is a little bit higher. Investing in passion projects is a way to explore your interest and make money as well. So the wealthy has many ways of exploring that. For the top 1%, investing in certain items can give you a sense of status and exclusivity that you can really enjoy. It makes you feel proud. And if these items increase in value over time, it's a win-win situation as well. But it's not just all about money. Investing in passion projects can also be an opportunity for personal growth and creativity. Investing in gold can be an attractive way for high net worth individuals to diversify their portfolios. Gold is seen as a safe asset or a safe haven type of asset because it provides some degree of stability when other investments are struggling. It also has the potential to appreciate over time because it doesn't really follow the same patterns as other asset classes. Some of the major ones do, making it very useful for hedging. So when some other asset classes are down, you can use gold to hedge up or try and balance it out, if that makes sense. But there are some downsides to investing in gold as well that I need to highlight. It can be expensive to store and insure, and the value can also be unpredictable, leading to potential losses. Also, gold doesn't really generate any income much. I mean, it isn't like, stocks and shares, so you have to wait for a long time for their return. It can also be very hard to sell very quickly because of the large amounts that you have to transact. And this can increase the risk of having to sell at a lower price, which is at a discount, or paying higher fees to attract other investors or buyers. One special type of cryptocurrency that a lot of people were hyping over during pre-COVID was NFTs. And they represented unique items like art and music. Because they were seen as rare collectibles, people were willing to pay high prices for NFTs like vintage albums, original work of art, or even contemporary art. Before COVID, many wealthy individuals were interested in NFTs as a way to make money, diversify their portfolio as well, or maybe even try and experiment to see whether or not they can make money by testing it out, It's one of the ways the wealthy try to diversify their portfolio, just to see whether a small amount of it can actually do something. But now the NFT market has taken a huge hit. The biggest NFT market, OpenSea, saw trading volume drop by 99% between May and August 2022. There are a lot of reasons behind this drop, like shady practices and scams on NFT websites, and a domino effect caused by other cryptocurrencies disrupting the market. Also, many people were afraid of missing out and they swarmed onto it And when it became popular, the share prices went way up. They bought it during the high times and they thought it was going to go up forever. And they sold when they saw it going down. It became shaky. In investing, we call this weak hands, where investors who lack strong conviction sell off assets due to their fear of losing money. Okay, so let's conclude here. In the report, it is fascinating to see how the wealthy are actively seeking new opportunities to diversify, maintain, and grow their portfolio. One trend that you can easily recognize in the report is the long-term benefits of investing in property and equity in companies, which has historically beaten inflation. The report's findings reflect current market trends, which are shaped by geopolitics, macroeconomics, and the aftermath of COVID. It's also clear that the wealthy have a knack for making money and seizing opportunities, which is why they remain successful in their future or current or whatever pursuits of wealth. In their endeavors, they're just very good at sniffing where the money is at. Funny enough, it is not all about money though. It's not all about just the profit. Many of the wealthy also want to do something good. They want to set a positive impact. What's the point of having all the money and not have a proper legacy or a healthy legacy? Environmental, social, and governance, ESG, are crucial factors that companies must consider to ensure sustainability. The wealthy recognizes this, and the wealthy also contribute to ESG initiatives by investing in companies that use or follow ESG practices, using donations such as promoting sustainable initiatives like renewable energy, saving trees, better healthcare facilities, education, and clean water as an example. The wealthy can also use their influence to advocate for policies in support for fair and sustainable development for everyone. So where there is great power comes great responsibility, and this is what they are also recognizing as well. What legacy do they want to leave behind? What do they want to be recognized for? And this is all the things that I took from that portfolio and the things that I've just explained to you. I hope you've enjoyed my video. And if you have, please make sure you like, subscribe, hit that bell notification so that you do not miss any updates. I don't know how many words I've said, but it sounded really cool, like I was rapping. Make sure to let your money run in the stock market. But this time is like, make sure you let your investment diversify. Sounds very cheesy.